Hey traders, Jason here from Lever Brothers. So in this video I'm going to talk about a couple of mixed signals that the market currently has. I know the S&P is near its high. I know the NASDAQ 100 is near its high. Something just seems off. I don't know why. There's definitely some stocks out there doing incredibly well. But there's also a lot of stocks that aren't doing that well, and there's a lot of stocks that are like moving and then giving everything back, and it just doesn't seem, considering we're at the highs and the trend is up, there's something just seems off. Okay, it's just not it's definitely not like 2023-24 where you could be a little bit careless. Like something's off. So I'm going to look at a couple studies that maybe point to this. All right. So first of all, I've gone over the January barometer. January barometer literally says, like, as January goes, so goes the year. If January is up, the market tends to do very well. If January is down, the market tends to not do very well. So, and here's a chart that maps out. Here's the end of January. Okay, so when the market posts a gain in January, it averages that, and then you can see that the market tends, that's the path, that's the average path it follows going forward the rest of the year. And if the market posts a loss in January, on average it's that, and then the market essentially is flat going forward the rest of the year. So as January goes, so goes the market. There are the numbers since 1950. That's pretty convincing that, when the market does well in January, the market tends to do well for the entire year. Okay, and this year the market did indeed post a gain in January, so that bodes well going forward. Here are some numbers to back that up. Okay, so here when you get a positive January, on average the market goes up about 12%, and it posts a gain about 86% of the time. When January is negative, the market only posts a gain 60% of the time, and that gain averages 2.1%. So you can see the difference between these is pretty big. When January is up, there's a much higher probability that the market's going to post a gain for the year, and then that gain is going to be significantly higher. And then compare that to all years. On average, the market goes up 75% of the time, and it posts a gain about 8% of the time. So you compare these, a positive January does actually bode well for the rest of the year, and a negative January does not bode well at all. Okay, so these numbers just match up with the chart that I just showed you. Okay, and again, January did post a gain this year, so that looks good. Another one that Ryan Dietrich just posted a week ago was something he called his Valentine's Day indicator. It's essentially if the market is up 3% or more on Valentine's Day, February 14th, then the market tends to do very well the rest of the year. So going back to 1950, here are all the years that the market was up 3% or more on Valentine's Day of a particular year, and then here's what the market did the rest of the year. And you could see that it was up 93.8% of the time, and the average gain was almost 14%. You compare that to, in all years, it's only market is only up 73.3% of the time, and the gain is only 7.7%. So when the market's up 3% or more on Valentine's Day, there's a higher probability it's going to post a gain the rest of the year, and that gain is, significantly higher than all other years. So that bodes well too. Okay. Now, but there's one study that is pretty big study that we've looked at, that's been looked at for a long time, and that is the ability of the market to not go below the December low. If it goes below the December low during the first quarter of the following year, it does not bode well. So in this chart, or in this table, I should say, these are all the times since 1950 that the market went below its December low. So here are all the December lows going back to 1950. Here are all the Q1 lows, okay? And then here are the full year returns, okay? So you can see that down here at the bottom, you can see in 2000, the December low of last year was 58.67. The Q1 low so far is 58.27, so we did in fact go below the December low so far in Q1. And you can see the full year return, there's a lot of red here. It's like, the average return is negative, and the market posts a gain only about 49% of the time. Okay. So this is a headwind that the market has to deal with. Yes, the January was up. Yes, the market was up more than 3% on Valentine's Day, but the fact that the market dropped below its December low during Q1 so far does not bode well. So we have conflicting signals. I'll just throw up a chart here. This is the S&P 500. There's your December low over there, and you can see the January low went below it. Okay, so we have conflicting signals. Okay, the market seems to be doing okay. Well, more than okay. The market's doing pretty well on the surface. Trend is up. S&P 500 near its all-time high. NASDAQ 100 near its all-time high. January barometer, check. Valentine's Day indicator, check. But by virtue of dropping below the December low, we have a little bit of a headwind. So we have like mixed signals. The coast is not clear. I think we know this anecdotally just from placing trades and seeing how they work. Some of them are working, some of them aren't. Even the ones that are working, a lot of them, some of them have done great, but a lot of them are, they work for a few days and then back off. There have also been some big earnings disasters. It's not an environment where I could just say like, hey, let's be all in here because the market's just kicking butt. Okay, just throwing it out there. We have some mixed signals. I don't know if we have a clear path going forward. I think bias is certainly to the upside because that's the trend is up, and a lot of the indexes are trending up and near their highs. But it just doesn't feel like an environment where I want to be all in and taking on some size. All right, hope you got something out of this, and I will see you next time.